All right, we are on to the next learning objective in chapter 1. We're going to be talking about different organizations and rules that govern the accounting for them. Okay, so the first one is the Financial Accounting Standards Board. We call that the FASB. That is the highest authority. There is a lot of other organizations that make up the rules of accounting, but FASB is the one at the very top. Okay. Then we have the Securities and Exchange Commission, which they oversee corporations. And you may be thinking, I don't know what a corporation is. We're going to talk about that either this video or the next one. Okay. But they govern corporations because corporations issue stock to the public. Okay. So the SEC sort of governs that. A lot of these financial statements have to be submitted to the SEC, and because they are looking out for the general investing public. Okay. Then we have International Financial Reporting Standards. We call this IFRS. We actually offer international accounting and law here at CBC. If you're an international business major, you will probably take that. You'll have to take that class. Accounting majors, it's not a requirement for them, but I try to get them in that class because it gives them 3 more upper level accounting hours to sit for the CPA exam. Okay. Who comes up with those rules? That would be the International Accounting Standards Board. Okay. IFRS are currently used in more than 166 nations and jurisdictions. Here's my prediction. I think GAAP is US rules. I think that probably in my lifetime or before I retire, GAAP may go away and it will all be International Financial Reporting Standards because US companies already have the choice. They can use GAAP or IFRS, and a lot of those companies choose IFRS because they do have operations in different countries. Okay. So just keep that in mind. Some of these rules might change a little bit as you go through your career. And so you have to stay up to date on those. All right. So let's talk about the US rules. We have what's called GAAP, not the store at the mall, generally accepted accounting principles. Okay. So I always throw this out. Think about car manufacturers here in the US or really anywhere else. If they're marketing and trying to sell cars to Americans, there's a standard on how they put seatbelts in. It doesn't really matter. I have a Toyota, a Nissan, and a Honda. The standards for putting seatbelts in those cars are a standard. Okay. Just like those things, GAAP is our standard. Okay. If we did not have a set of rules that we used, think about the fact that Kroger could use their rules, Walmart could use a different set of rules. We'd have to learn both of their rules and then be able to compare the financials together. So we don't do that. We don't let just any company use what rules they want to. All the companies have to use generally accepted accounting principles. Okay. Some smaller organizations like small businesses, they may not fall underneath GAAP so much, but they would probably have to be on a tax basis because they're very small. Okay. So one of the things that accounting information underneath this rule of GAAP is that information needs to be relevant. Okay. Relevant to make decisions. Think about Walmart's financial statements for 2024. That's pretty relevant right now. Let's think about Walmart's financial statements going back 30 years ago. We don't, that information is really not relevant to us right now, is it? It might be interesting. It might be neat to look at graphs from sales over those years, but that's not really relevant information. Okay. So we want information to be relevant. We want it to have a faithful representation. Okay. Sorry, I mean to mark that out. Faithful representation by being complete, neutral, and free from error. It needs to be correct. It needs to be complete. And it is what it is. There's no bias in it. So I always think of like a bank statement. A bank statement comes from another entity. You've got a checking or savings account with that entity. You get this bank statement. It has all of those characteristics. It is complete. It's usually for a month, January 1st to January 31st. It's neutral. It is what happens. There's no bias in that statement at all. Okay. We hope that it is free from error. That's why you do a bank reconciliation, to make sure that you didn't do something wrong or the bank did something wrong. And I know most of y'all are like, I don't do a bank reconciliation. I don't keep up with the check register. I just look on my app every single day to see how much money I have. Well, we can't do that in the business world. And you really probably shouldn't do it in your personal. You should have a record of what you're spending, because the bank can make a mistake. Okay. The bank can make a mistake. All right. So faithful representation. We have a couple of, we're going to look over some of these assumptions, and some of the, we're not going to cover them all in one chapter. We kind of hit on them as we go through all of the chapters. The one that is very, very important right here is economic entity assumption. Okay. So if you think about, we have a gas station, and then there is a McDonald's right next to it. Okay. The same proprietor may own both of those. Okay. And that's okay. But that proprietor needs to keep the gas station books separate from the McDonald's books. Okay. The gas station may be supporting the McDonald's, and McDonald's may be supporting the gas station. Okay. It's very important, because if you mix all those records up, you don't know which one's making you any money. Okay. So you need to keep those separate. So we're here at a Christian college. You could have another example. You could have a church, and that church could have a school. You want to make sure you keep the church records separate from the school records. The church may be supporting the school, or the school may be supporting the church, but you need to know which one it is. Okay. That hits home, because we do have a lot of students who come from private schools that are connected to a church somehow or another. And then the water can get so muddy. We were talking about that earlier in the first video, how the water can get really muddy if you don't know, if you're commingling all of those funds, you don't know. So if you're a pastor and you don't know if the church, you don't know whether to preach, pay your tithes, or you don't know whether to raise tuition at the school if you don't keep those records separate. Okay. That one usually hits home, because we have a lot of students coming from at least churches, and some churches have schools attached to them. And I'm not saying those are bad things at all. I'm just saying you need to keep the records separate for both of those. Okay. So, economic entity assumption, you also want to keep your personal stuff separate from your business. If you have a small business, you need to keep your personal finances separate from the business. Okay. So, economic entity assumption just means we're keeping each one of those separate. Okay. Next thing we're going to do is talk about an economic entity. We have several different ones. We have sole proprietorship, partnership, corporation, and LLC. There is more. We're just covering these four. Okay. We used to not even cover the LLC. We just did those three. But I had students, this is my 21st year of teaching this. I've had students come up to me before, and they're like, Miss Solano, there's like an LLP. There's a S corporation. I was like, I know this, just the textbook doesn't go into that much detail. Okay. So let's talk about these. We have a nice little graph here, gives us a lot of information, but I kind of want to go over here in the margin and kind of talk about each one of them just a little bit. Okay. So a sole proprietor, that's the first one we're going to talk about. This is a single owner, one owner business. They usually call that the proprietor. When the owner of the sole proprietorship dies, the business dies. Okay. So it has a limited life. Okay. And the thing we don't like about sole proprietorships is it has unlimited liability. So, long time ago, I was a sole proprietor. I've been a couple of times, a couple of small businesses. One of them was Heather's Solano's income tax preparation. Okay. I was a one owner business, um, had a limited life. So that means if I die, then Solano's income tax preparation is dead also. Now, somebody, maybe my daughter or somebody, would take those clients and maybe a new proprietorship would open, but that proprietorship is dead. Okay. When that owner dies, it's dead. Okay, so that's the limited life. The unlimited liability. So let's just say Solano's income tax preparation took out some debt and to buy some things and then didn't make enough money to be able to pay those bills. They do not look at Heather's tax preparation business as an entity all by itself. It's an unlimited liability. So if the business goes bankrupt or gets sued, they will cross that umbrella over into my personal assets, my inherited property, my cars, my house that I'm living in. All of those assets that I have, they can cross over. There's no separation on that. So they could cross over, take my inherited property, do anything they want to my personal assets. So this is something we don't really like about a sole proprietorship. That's why most people pick something else other than being a sole proprietor. Okay. Um, just kind of want to scroll down here. Okay. Taxing, it is only taxed once. Okay. This is very important until we get down when we're talking about corporations. Okay. So the next one we're going to talk about is a partnership. Okay. Almost everything is the same between a sole proprietorship and a partnership, except for it is two or more owners. Okay. It still has a limited life. Okay. If one of the partners dies, that partnership is dead. Okay. It terminates then. A new partnership may form after that, but that partnership is dead. It no longer exists at that point. Okay. It still has this thing we don't like, unlimited liability. But now let's think about it. So let's just say I had a partnership, and in that partnership, I had Susan was my partner, and I made a bad business deal and I just bankrupted our partnership. I just risked her assets as well as my own. So there's that mutual agency when it comes to a partnership. So you've got to think long and hard about who you're going to be in a partnership with, okay? Because they could make a bad business deal and bankrupt you, or you can do that to them, okay? So we still have that thing that we don't like is unlimited liability, okay? And partnerships are only taxed once, okay? So now let's talk about corporations. I like to explain corporations. I like to draw a big circle. This is how I've always done it. And in this circle, this is like a pie. And we have slices of the pie. We could have a teeny tiny slice. We could have the whole pie. So it could be one or a million owners, one or many owners. Okay. Oops, sorry about that. Okay. So it could have a lots of, and those owners, those are stockholders. They own pieces of the pie. That is what we call shares of stock. Okay. So a corporation is a complete separate legal entity. Okay. And it has a couple of characteristics that we like. It does have some disadvantages, but one of the things we like is it has an unlimited life. Unlimited life. This corporation could live forever. It doesn't matter if I'm this one little happy stockholder over here, and I own one share of Walmart stock. If I died today, Walmart's not even going to send an email out saying that I died. Okay. My heirs, people who inherit my property, would inherit that share of stock. Walmart's not going to miss a beat. Like I said, they're probably not even going to send out a sad news email. The only way they probably would is if I like owned a bunch of shares of Walmart stock. Okay. So it doesn't miss a beat. It just keeps going. So it has unlimited life. Okay. And I always like to ask this question of students. Do you think that corporations pay their fair share of taxes? Now, I want you to think about that. We're going to come back to it here in just a second. Okay. So, corporations have an unlimited life. These are usually really large businesses. Okay. They can have one or many owners. Okay. So, right here at the corporate level, a corporation is taxed the first time. Okay. So they're taxed once at the corporate level, which is 21% across the board right now. That could change if you're watching this video in a few years. As of fall 2025, most corporations have a tax rate of 21%. That is down from where it used to be like really, really high. Okay. Not going to get into politics or anything, but it does hurt my feelings when I hear people talk about these greedy corporations. They don't pay their fair share of taxes. Okay. I asked you that question and you're thinking about it. You're thinking, oh no, they don't pay enough taxes. All right, let's talk about me right here as the shareholder. I own one share of stock. When the corporation decides to pay out money and earnings, they're going to pay that out in dividends. When I get my dividend check from Walmart, it's going to be taxed again. Okay. So it's taxed for the second time. Okay. Once I get it. All right. Um, and that is just the way it is. It is a double taxation. So when people say corporations don't pay their fair share of taxes, I really want to just let them watch this video for a little bit because that is actually not how it actually is. Corporations pay a lot of tax. Okay. So let's think about this. Who are these people? Because I just used myself as having one share of Walmart stock. These people who are owning these stocks, yes, some of them might be Bill Gates, Elon Musk, and Jeff Bezos, but there's a whole lot of them that are me and you. If you have a retirement fund or you're if you don't right now, you're going to have a retirement fund. Your retirement fund is invested in stocks and bonds from corporations, okay? So you may be part of your portfolio in your retirement plan has some stocks. Guess what? Those stocks are getting double taxed. So when they are lowering the corporate tax rate, don't be upset because that's helping you. It's actually helping everybody because when the corporation's taxes go down, they can employ more people. They can employ more people and then those people pay taxes. They can employ more people and then more taxes are collected. Okay. So corporations in it, are there bad corporations? Yes. I'm not saying they're all good, but just as pure definition, a corporation isn't all bad. Yes, we have had some major accounting frauds like Enron and WorldCom. Those were bad corporations, but not all corporations are bad. Okay. So just keep that in mind. And I also think every tax that is even put on a corporation or anybody always trickles down to the customer. So if Walmart's tax, you know, if they raise those tax rates, guess what? They're going to charge us more for the stuff that we're buying at Walmart. Okay. So this is not my opinion. This is just factually how it works. Okay. So it's not an opinion. So when people talk about those evil, greedy corporations need to pay more taxes, really, no, they don't because they're already double taxed. Okay. So that's a corporation, has an unlimited life. Why are we willing to take this horrible thing called double taxation? Well, there's this thing called limited liability. Remember the partnership and sole proprietorship had unlimited liability? Now we have some protection. So I'm this happy little Walmart stockholder and I only own one share Walmart stock. If Walmart goes bankrupt, yeah, I'll lose the money that I put into the business, but they can't cross this bubble into my personal assets. Okay. So that is why we're willing to accept that double taxation so that we can limit our liability. I put life and I meant to put liability. Okay. So those are the three main types of entities. We have the LLC, and I'm just because we've kind of compared all of these already. So I want to come over here and just the limited liability company is going to take the best of these three and put them together. Okay. Um, it's a company which each member is only liable for his or her actions, which helps. Remember that mutual agency. It could be one or more members. Okay. It could have an indefinite life. The members are not personally liable, so we get some of that limited liability. The LLC isn't taxed. Instead, it's more of a flow through organization. The earnings are going to flow through to those members, and then they will pay tax only once on it. Okay. It's an alternative to a partnership, and it sort of helps out, kind of takes the best of both worlds of all of these and puts them together. A couple of years ago, I just did a little research. I was like, then why does anybody even become a corporation? Mainly because the bigger your business wants to be, it pretty much has to become a corporation. So LLC would probably be somewhere in between. You have a sole proprietorship, it's getting a little bit bigger. We're going to turn it into a limited liability company. And then it may go public later on as a corporation. And a lot of businesses that are corporations right now started as a sole proprietorship. Okay. So those are the types of organizations. We have a couple of different rules left before we're done with this learning objective. So we have what's called the cost principle. Cost principle says we record things at what we paid for them. Okay. Long time ago, I bought a minivan that had a fair market value of $22,000 a long, long time ago. This really happened. But due to the fact that this minivan went through a tornado and all the windows were blown out in it, we only paid 12,000 for it, and they replaced all the windows in it. But they had to sell the inventory to figure out how much of an insurance claim they would have. So, to them, that's how much they lost on it, and they can kind of tell. But we got a good deal. Feels great. It feels good when you buy something and then it's worth more than what you paid for it. We feel good. We feel like we got a good deal. I would argue that the fair market value is probably 12,000 because that's what we were willing to pay. But in this example, that's not the case. It was worth that. It was a great vehicle. We drove it way more than the $12,000 it cost us. But if I was recording this vehicle in my accounting records, I would record it at 12,000. Okay, not the fair value of the 22,000. That just makes us feel good. Okay, GAAP, US accounting does not record this fair market value. If we've moved over into IFRS, the rules are a little different on that. Okay. We also have what's called going concern. This just means we are not about to go bankrupt. Okay. Our business will probably be there at least a year. It's really hard to know what's going to happen 5, 10 years down the road. So a lot of times when we're thinking about going concern, we're looking at, will it be here in a year? Yes, it probably will. Monetary unit assumption, that's really easy. We use the dollar. We're here in the US, we use dollars. Okay. All right. Um, Last slide for this learning objective. I've kind of talked about what an audit was. This is that independent CPA that goes into a company and they examine the financial statements. Okay. We have Sarbanes-Oxley. This legislation came about in 2002, and the reason it came about was I mentioned it earlier. We had WorldCom and Enron were two major accounting frauds. They were both accounting frauds. They were different from each other, though. But those two huge accounting frauds triggered legislation to change. We got a new oversight board. A lot of people think that we were the wild, wild west of accounting before Sarbanes-Oxley. We had rules. It's not like we were doing, I mean, we had rules, but I equate it to making another law to make us feel good, right? That's really all it was. We've got Sarbanes-Oxley now. Yay! We're never going to have another Enron or WorldCom. Well, that was in 2002. We have had more Enrons and more WorldCom. People who are going to break the law are going to continue to break the law. They don't care what the law is. Okay. We just hope that our auditor can find the fraud. Okay. Um, so but we do have Sarbanes-Oxley and we have a new oversight board. And I know you're probably thinking that was 23 years ago, Miss Solano. It is the most current of all of the accounting fraud and legislation. So that's why we still talk about it. It's kind of like, we still all look back to the Great Depression. A lot of things going on today happened because of the Great Depression. The accounting fraud of 2002 triggered Sarbanes-Oxley. Okay. All right, and that's all for this video. I'll see you in the next one.